So last time we discussed this chapter on capital structure without taxes. So what's the major content of this chapter? Well, it's really about this MM theorem, right? Remember that MM theorem has two components. So um, the main content is about MM theorem, and it has two propositions. Right? Proposition 1 and proposition 2. So what is proposition 1? In terms of formula, it's really simple, right? It's basically d plus, it's basically d plus e equals a, or equals u. That is, no matter what is your choice of debt versus equity, the sum, the total of debt plus equity is always the same. That is, firm's value is independent of your capital structure choice. So what's the explanation behind this theorem? Well, because we're talking about a perfect capital market, and the your capital structure is assumed to not affect your firm's cash flows. And if your capital structure does not affect your firm's cash flows, then it should not affect your firm's value, right? Because firm's value is essentially the present value of firm's future cash flows. So if cash flows stay the same, the firm's value stays the same. So that's the rationale behind MM proposition 1. Now, what about MM proposition 2? MM proposition 2 is about the cost of equity, right? So basically, in terms of formula, MM proposition 2 says RE equals RU plus D divided by E, RU minus RD, right? So here RU is the unlevered cost of capital, and RD is the debt cost of capital. Then, of course, RE is the equity cost of capital. And what's the economics behind this formula? Well, it basically says that if you have higher debt in your firm, right, that is, this guy becomes larger. If you have higher debt, then the cost of equity will be higher. That is, as you increase debt in your firm, even though the weighted average cost of capital stays the same, however, equity becomes riskier because of debt. So as you increase the usage of debt, the cost of equity will also increase. Okay, that's basically the major content. Of course, again, for winning in your homework and in your final exam, you still need to pay attention to the problems in our lecture notes and the problems from our homework, right? You guys could actually see this from your middle term. There's a problem in the force. So there's a question from the force problem. It's about the expected return, and it's about if you invest. I think it's so if you invest Google for the first year, and if you invest Apple for the second year, and then if you invest a risk-free asset in the third year, then what is the expected return? I am working on your middle term, and my finding is, I would say about 60 to 70% didn't get that problem right. It's quite shocking, right? Because this problem actually is very similar to a problem from your homework, right? So again, please make sure you understand problems from lecture note, from homework. I mean, even if in the future you're taking a exam in CPA or even CFA, it's still about solving problems, right? So you should put some effort into solving these problems. Okay, now let's look at the last section of this chapter. It's called capital structure fallacies. So basically, we would try to present you some fallacies, and then you will need to understand what kind of mistakes, right, we're making here. Just consider this last section as a practice, right? As a section which helps you to understand what you have learned from section 1, 2, and 3, right? Okay, let's start section 4. Sorry. So now we would look at two incorrect arguments about the use of leverage. So basically, we will talk about two fallacies, right? Now, the first fallacy is about the use of leverage and earnings per share. So, what this fallacy is about? It basically says leverage increases a firm's expected earnings per share. So, leverage should increase the firm's stock price. Now, basically, this statement can be divided into two components, right, or two parts. The first part says leverage increases a firm's expected earnings per share. You will see that this first part is actually correct. Now, what about the second part? The second part says, so we should use leverage because leverage should increase the firm's stock price. Well, this is actually incorrect. It's actually quite interesting, right? Think about it. What is earnings per share? It's essentially as a shareholder, right? If you hold a share, then how much earnings you can get. Obviously, shareholders like higher earnings per share. So basically, if you have higher earnings per share, it seems that your share price should increase, right? But you can see that here, even if you use leverage to increase your earnings per share, your share price, your stock price would actually not increase, right? So it's actually a quite a interesting result. So let's see why this is a fallacy, right? So we would understand this fallacy through a simple example. So we have a firm which is called LVI. In the beginning, it's a all equity firm. Right? Again, all equity firm means this firm does not have debt and it's totally unlevered. It expects to generate earnings before interest and taxes of $10 million over the next year. So it has a EBIT of $10 million. And now this firm has 10 million shares outstanding and its stock is trading for a price of 7.50. So just by the number of shares and by the share price, we could know what is this firm's value, right? So this firm's value is $75 million, right? Because this is an all equity firm. So the market cap of this firm gives you this firm's total value. LVI is considering changing its capital structure by borrowing $15 million at an interest rate of 8% and use the proceeds to repurchase 2 million shares at 7.5 per share. So you can see that this firm is essentially doing this so-called leveraged recap, right? Remember, leveraged recap basically means you would use borrowed money to buy back shares. And after buying back shares, your the percentage of equity in your firm will decrease, and accordingly, the percentage of debt in your firm will increase. So you can see that essentially leverage recap is a way of increasing your firm's leverage. And we also learned through the example from this chapter, we learned leverage recap should not change your share price if the capital market is perfect. Right? So that's why this firm can repurchase shares at the $7.5, right? Because stock price should not change. Now, you can see that basically if the firm uses the proceeds to repurchase 2 million shares, the firm's stock will decrease from 10 million shares to 8 million shares. Right? Now let's see how the firm's earnings per share will change. That is, we will try to calculate the firm's earnings per share before the leverage recap and after the leverage recap. Right? Now, what is earnings per share? Well, it's pretty simple, right? So earnings per share equals earnings, or I would just use net income, right? Net income divided by number of shares. So our task is to find out the earnings per share before and after the leveraged recap. So let's do this. Let's start with, so let's calculate EPS before the leverage recap. So let me call this EPS B here, right? What is the number of shares? Well, we learned the firm originally had 10 million shares. So you would use 10 million here. What is this firm's net income? Remember, net income equals EBIT. Oops. Minus interest expense. So let me use IE here, interest expense minus tax, right? And we know this firm has a EBIT of $10 million. So let me see if it's 10. Oops. Oh boy. Oh, sorry. That's weird. Okay, let me reopen the lecture note. Sorry for that. I think we are looking at this. Okay, great. So we know EBIT is $10 million, right? And we're looking at this perfect capital market. Remember, one assumption of perfect capital market is no taxes, right? So we would remove this guy here. Sorry. Now, what about interest expense? Well, before the leverage recap, the firm was an all-equity firm. So this implies interest expense equals 0, right? So I would just remove this guy here. So the EPS here is really equal to EBIT divided by $10 million. Sorry, 10 million shares. And EBIT is 10 million. So EPS before the leverage recap is $1 per share. Now we want to look at the EPS after, right? Now again, we will look at net income divided by number of shares. So EBIT minus interest expense minus tax and number of shares. Now we still have EBIT, which is $10 million. Interest expense is pretty easy to calculate. We know the firm has a debt of $15 million. And the interest rate is 8%. So $15 million times 8%, which gives you, how much? I think it's $1.2 million. And still, there's no tax, so minus 0 here. Then, what is the number of shares? Well, we have a total of 10 million shares, and after repurchasing 2 million shares, the residual number of shares is 8 million, right? So divided by 8. this gives us 1.1, right? So you can see that that's why I said the first half of the statement is correct. That is, if you compare this number with this number, you can see that after leverage recap, after increasing leverage, the firm's earnings per share is indeed higher. Now, as I mentioned, investors like higher earnings per share, right? But does this imply investor will be happy to pay a higher share price because of the higher earnings per share? Well, it's actually not, right? So what's the rationale? Why investors are not happy to pay a higher equity price despite of higher earnings per share? Well, it's because as the firm increases its leverage, equity will become riskier. So you can see the problem here. Even if you have higher EPS, but since the risk of equity increases, investor will actually use a higher discount factor to discount those EPS. So in the end, the discounted value will stay the same. Very quickly, you will see an example which exactly shows you this is the case. Okay, let's use a picture, right, to show you that the firm's EPS indeed becomes riskier with leverage. Right? So let me explain this graph to you. So the first column discusses 6 different scenarios of EBIT. Right? So the firm could have $0 of EBIT, or the highest one, that is $20 million of EBIT. And then we will look at this unlevered EPS. Unlevered EPS is pretty easy to calculate, right? Because we just discussed for unlevered EPS, it equals EBIT divided by number of shares. And we have 10 million shares. So basically you can see that you can very easily get these numbers. For example, this guy is essentially $4 million of EBIT divided by 10, right? Equals 0.4. And you can do the same for all other different levels of EBIT, and you will get these different levels of unlevered EPS. Now, the more important part is about levered EPS. Again, we have calculated levered EPS. It's essentially EBIT minus interest expense divided by number of shares. And we know that interest is always 1.2, and number of shares is always 8 million shares. So we could try to calculate this 0.6 levered EPS, right? So you can see that it equals EBIT, which is 6, minus 1.2, which is the interest expense, divided by 8, which is the number of shares. So this gives you 0.6, which is the levered EPS. Okay. Next, we could go away from the table. We could draw the numbers from the table on this picture here, right? You can see that you basically have 2 lines, right? The first line, the line in red is the EPS with leverage, right? And then the line in blue is the EPS without debt. You can see it's pretty easy to draw out these 2 lines. So basically the horizontal axis is given by EBIT, that is this column, right? And then the vertical axis is given by earnings per share. So you would just draw out this column and this column, right? Then you will have 2 lines, levered EPS versus unlevered EPS. Now, what you can observe here is these 2 lines, they have different slopes, right? Their slopes are different To be more specific, the red line has larger slope. That is, it is steeper, right? What does this mean here? Well, it basically means the variation for this EPS with debt is larger, right? Because it has larger slope. Again, you can see this. Let me give you an example to show why larger slope gives you larger variation. You can see that if you go from 6 to 12, right? Let's say, okay, let me use a different color. So let's say the EBIT increases from 6 to 12. Now, what is the increase in EPS without debt? Well, it's given by this green line here, right? So this is the change in the EPS without debt. Now, what is the change in the EPS without, sorry, what is the change in EPS with debt? It's here, right? So you can see that the change in EPS with debt is larger compared with the change in EPS without debt. This essentially says there is larger variation in EPS with debt, right? And if there is larger variation in EPS with debt, this implies EPS with debt is riskier, right? You can also see this from minimum value and maximum value. If you look at this unlevered EPS, its minimum value is just 0, and its maximum value, its largest value is 2. So you can see that its difference is 2 here. Now, look at the levered EPS. Its smallest value is minus 0.15, and its largest value is 2.35. So the difference is, I think it's 2.5. Yeah, it's 2.5. So obviously, the difference in levered EPS is larger, right? So this again tells you larger variation in levered EPS. Levered EPS is riskier. Okay, now let's exactly look at how could we calculate the firm's equity price using this example here. So assume this LVI, its EBIT, is not expected to grow in the future, and all earnings are paid as dividends. Use proposition 1 and proposition 2 to show that the increase in expected EPS for this firm will not lead to an increase in the share price. So let's think about this, right? How do we solve this? So we basically have the firm's earnings, right? We have this firm's EPS. We have done the calculation. That is, if there was no debt, the firm's EPS would be $1 per share. With debt, the firm's EPS became $1.1 per share, right? So that's the basic data we have here. So this reminds you, well, maybe you could use dividend discount model, right, to calculate the firm's stock price. So let's try to use dividend discount model. So here we would know that the basic formula, right, is P equals dividend divided by R minus G. You should have learned about this in Corporate Finance 1. So what is R here? R is really the cost of equity. What is G? G is this growth rate. And you can see that in this problem, we assume EBIT is not expected to grow in the future. So G here should be equal to 0. So the formula should be simplified as dividend divided by the cost of equity, right? Now, do we have data on the cost of equity? If you look at the problem here, we have a bunch of numbers. Right? We have the share price, we have number of shares, we have EBIT, but we don't really have cost of equity, right? So how do you solve this? Okay, let's see how could we solve this difficulty. Let's just first see what numbers we have here. So our purpose is we want to show that the firm's stock price after the leverage recap is actually $7.5. Right? Because if you go back, you can see that the stock price is 7.5. Right? We want to show that the stock price is indeed 7.5. So we want to show dividend divided by R equals 7.5. What is the dividend? Well, we know that the dividend is $1.1 per share, right? Because the firm would pay all, because the firm would pay all earnings as dividend. So earnings per share would just become dividend per share, right? So now our question is, how could we find out this RE, right? Well, we learned from proposition 2. RE equals RU plus D divided by E, RU minus RD, right? So let's see if we could use this proposition 2 to find out RE. And let's first check what kind of numbers do we have here. Do we have D? Well, we do have D here, right? D is the amount of debt. And then we know this firm borrowed $50 million. So that is great. So the firm would borrow $50 million. What is E here? Do we have the firm's equity? Well, we know the firm's original value before leverage recap was $75 million. And now the firm has borrowed $50 million. So we can back out the firm's equity. It's just the 75 minus 15, right? So here the equity is 75 minus 15, which is $60 million. Do we have RD here? I think we do have RD. Oh, yeah, here you can see that the problem says the interest rate is 8%. So do we have RU here? Right, what is the unlevered cost of capital? Well, you can actually find out the unlevered cost of capital using the firm's share price before the leverage recap. So we know that the firm's stock price before the leverage recap was $7.5, and its dividend before the leverage recap was $1 per share. And supposedly you should use the equity cost of capital to discount this firm's EPS. However, here, this firm is an all equity firm. So its RE actually equals RU, right? So in this case, you can find out RU equals 1 divided by 7.5, right? So that's great. Now we have all the data we need. So 1 divided by 7.5. So if we plug in D, plug in E, plug in RD, plug in RU in the above proposition 2 formula, we could find out RE equals, so I would just copy the answer from the lecture note. So it's 14.66%. And next, we would use the the EPS after the leverage recap, and we would divide this number by 14.66%, and this gives us exactly 7.5. Right? So now you have proved, yes, after the leverage recap, even if you have a higher EPS, the stock price would stay the same at $7.5. Okay, so let me maybe talk a little bit on this problem, because this problem is actually a little bit harder than other problems we have solved. First, you can see that this problem says you would use proposition 1 and 2 to show that the increase in EPS will not lead to an increase in the share price. So just think about it. How did we use proposition 2 and 1 in this example? So let me show you where I have used proposition 1. So if you look at these different steps, you can see that obviously we used proposition 2 here, right? Now, where did we use proposition 1? Well, it's actually here. So this is proposition 1. The reason is proposition 1 basically says even if you change your capital structure, your firm value would stay the same. So that's why you could use $75 million here, because firm's value before the leverage recap was $75 million. And according to proposition 1, firm's total value should stay as $75 million after the leverage recap. So that's why you would use 75 here, right? Again, so what is the whole picture of this problem? So basically, your purpose here is you want to prove even if you have a higher EPS, your stock price would stay the same. So you can see that, well, because it's very simple for you to find out this 1.1. The caveat here is how do you find out this RE, right? So we basically backed out RE using proposition 2, right? Okay, I think that's all I want to say for this problem. Okay, now let's move to the next fallacy, right? So this fallacy basically says issuing equity will dilute existing shareholders' ownership and reduce EPS, which reduces share price. So debt financing should be used instead. Okay, now let me explain this so-called fallacy, right? First, it says issuing equity will dilute existing shareholders' ownership. This statement is actually correct. So this part is actually correct. So how do you understand this dilution here? Well, it's actually pretty simple, right? So just think about this. If a firm has 100 shares, right? And then each of the shareholder will have 1% of this firm. Now, if you increase this 100 shares to 1,000 shares, now each shareholder will just have 0.1% of this firm, right? So you can see that there is dilution happening if you issue more equity. Now, what's incorrect is this statement. Reduce EPS, right? So this statement is not correct. You will see that issuing equity will not reduce EPS. So it will not reduce share price. So equity dilution is not a correct reason for increasing leverage. Okay, now let's see this very simple example here. So let's say this firm, JetSat Airlines, had no debt in the beginning, and it has 5 million shares, $6 per share. Again, this is the all equity firm. So given stock price, given number of stocks, you should be able to find out the firm's total value, right? So it's I think it's 8,000. Let me see. Yeah, 8,000 million dollars. Now, the firm sells additional 62.5 million new shares. So you can see that now the firm will have 500 plus 62. So the number of shares would become 562.5 shares, right? So this is the number of shares, and this is the firm's total value, or let me just use value, right? So this is the firm's value. Question: what is the share price after this firm sells new shares? How much money can this firm raise? Now let's see how could we answer these two questions. Oh, first you can see that you have the answer here, right? So share price would actually stay at $16 per share, and this firm would raise $1 billion, right? So how do you find out the share price after the firm decides to issue new shares? So let's say, okay, let me write it here. So let's assume, right, the share price is P, right? So let's assume share price is P after the firm decides to issue new shares. Let's see how could we find out P here. So you can see that after issuing new shares, the firm has 562.5 million shares. So the firm's total value, right? So the firm's equity equals the number of shares times share price, right? And we also know that previously the firm's value was 8,000, right? So we know that the firm's value was 8,000. And after the firm decides to sell new shares, the firm's value will increase from 8,000 to 8,000 plus 62.5p, right? Again, this is the original value, right? And this is the additional value from selling new shares. And you can see that this firm is always the all equity firm. So you can see that this value and this value should be the same, right? So 8,000 plus 62.5p equals 562.5p. Now you can see that this is a very simple equation to solve p here. So you can solve p equals $16, right? Again, the caveat, the key to solve this p is to use this equation, right? So the left hand side, so how do you get the left hand side? Well, it's because in the beginning the firm's value was 8,000, and after that the firm raised additional cash from selling new shares. Obviously, additional cash is counted as firm's value, right? So here you can see that the amount of additional cash is calculated by 60.2 additional shares times share price. And then because we know that the firm has a total number of shares, 562.5. So if the share price is P, then the firm's total value is also given by 562.5 times P, right? So you could solve P equals 16, right? It's tremendously simple, actually. And then after solving the first question, the second question is pretty easy to understand. It says, how much money can this firm raise? Well, you would sell 2.5 million additional shares, and these shares would be sold at $16. So you will raise 1 billion. Actually, for the first question, right? It's actually pretty obvious you will actually sell at $16 because originally or initially the share price was $16. And we know that if it's a perfect capital market, financial transactions will not create value. So this basically implies financial transactions should not change your share price. So even if you decide to raise more cash by selling new shares, then the share price would stay the same, which is $16 per share. Right? Okay. We could also understand this from this perspective of this market value balance sheet, right? You can see that in the beginning, existing assets were given by 8,000. That is $16 share price times number of shares. Oops. The number of shares is actually 500, right? Of course, shares outstanding 500, value per share $16. Now, the third column gives you the firm's value after equity issuance. So you can see that the firm sells 2.5 million shares at $16. So it will raise additional $1,000 million, right? So the firm's existing assets stay the same, 8,000. So the firm's total value would increase to 9,000 and share price would stay the same. So what this table is exactly trying to tell you, right? Well, it basically says this. By issuing new equity, right? By issuing new equity, the share increases from 500, right? It increases from 500 to 562.5. So there is dilution happening. However, because by issuing new equity, you will actually raise some cash. This will also increase the firm's value from 8,000 to 9,000, right? So you can see that as you increase the number of shares, firm's value also increases. So in the end, the share price would just stay the same. Okay. Okay, cool. Now let's do the chapter review here. First, how does the risk and cost of capital of levered equity compare to that of unlevered equity? Which is the superior capital structure choice in a perfect capital market? So we are comparing levered equity and unlevered equity. We know that as you use more leverage, equity will become riskier. So the cost of capital of levered equity will be higher compared with the unlevered equity. Second question, which is the better choice? Well, if the capital market is perfect, from the perspective of firm's value, there is no superior choice because no matter what kind of fraction you want to use, in the end, the firm's value would stay the same. What is the market value balance sheet? This is really better it's better for you to understand this just using examples, right? So market value balance sheet is really a balance sheet which records asset, liability, equity in or using market value instead of historical cost, right? In a perfect capital market, how will a firm's market capitalization change if it borrows in order to repurchase shares? How will its share price change? You can actually understand this from a very simple market value balance sheet, right? Just think about this. So let's say this is asset. Let's just start with the all equity firm, right? And asset equals equity because we don't have liability here. And if you use market value, if you use this so-called leverage recap, what would happen is you will get additional cash, right? By borrowing money. And then you will use cash to buy back equity. So in the end, the cash will disappear and this part of equity will also disappear. So in the end, you will still have the same amount of asset, and then you will have liability here and equity here. So basically, if you borrow money to repurchase shares, the firm's leverage ratio will increase. And we have also learned its share price will stay the same. Fourth, with perfect capital market, as a firm increases its leverage, how does its debt cost of capital change? What about its equity cost of capital, its weighted average cost of capital? So what you can see here is, first, its weighted average cost of capital should stay the same, right? And we actually learned about this. If you could recall, we have shown that WACC is just a horizontal line, even if you increase the firm's leverage, right? The reason is WACC really measures the firm's business risk. And if it's a perfect capital market, the firm's operation, the firm's business will not be affected by the firm's capital structure. So its weighted average cost of capital should stay the same. What about its equity cost of capital? Well, if you draw out the line here, so let's say this is leverage. And this is the debt cost of capital. What you will see is, in the beginning, the debt cost of capital would be equal to the risk-free rate. And after a certain level of debt, it will start to increase. The reason is because in this low debt range, there is no default risk, at least theoretically. And as you borrow more and more, the default risk will become larger. So investors, debt holders, they will demand higher return for bearing this default risk. So the cost of debt will increase. Now, what about equity cost of capital? If you again draw out this RE, and the horizontal is given by leverage. Now you can see that generally you will see RE continues to increase as you increase your leverage. Why? Well, first you could say that as you increase your leverage, equity becomes riskier, So the equity cost of capital becomes larger. And you could also use proposition 2, right? RE equals RU plus D divided by E plus RU minus RD. So generally, you can see that if this number D divided by E increases, RE would increase. So you will see that the curve of this cost of capital is upward sloping, right? Okay, fifth, if a change in leverage raises a firm's earnings per share, should this cause its share price to rise in a perfect market? This is obvious, right? Because we just discussed this fallacy in our like 10 minutes ago. Basically, even leverage increases a firm's EPS, the firm's stock price should stay the same, because using leverage increases the equity cost of capital. So you will use a larger discount rate to discount the firm's EPS, and in the end, the increase in EPS and the increase in the discount rate will offset each other. So firm's stock price would stay the same. Okay, let me start the next chapter, which is theorem with taxes. So in this chapter, we will deviate from the last chapter by assuming firms, they need to pay corporate taxes. You can see that this is a very realistic assumption, right? Because in reality, obviously, firms do pay corporate taxes. I mean, even they have different kinds of methods to avoid paying corporate taxes, but you can see that this is still a very important problem to consider here. So the major result of this chapter is when a firm pays out interest expense from using debt, the interest expense is tax deductible. So this will create the so-called interest tax shield. That is, the interest payments will be shielded from corporate taxes, and this will benefit the firm. So it will actually increase the firm's value. That's the gist of this chapter, but you can see that we will again do a bunch of calculations and try to precisely calculate how firms' value will increase because of the interest tax shield. Okay, now let's start. Okay, let's start with this very simple example here. So let's say we are looking at the income statement of shoppers. So let's say, we're thinking about two scenarios, with leverage, without leverage. Of course, you can see that this is basically a very standard income statement, right? So you have EBIT here, and you have interest expense here, and then you would have EBT here, earnings before taxes, and then you would pay corporate taxes, and now this gives you the bottom line, right? Your net income. Let's check these numbers. So obviously, you should have the same EBIT, right? Whether you're having leverage or you're not having leverage. And now we assume the interest expense is 57.6 if the firm is using leverage. And then you can see that obviously earnings before taxes would be lower if the firm is using leverage. And accordingly, because earnings before taxes is essentially the taxable income for the firm. So you can see that a lower earnings before taxes will lead to a lower tax. Right? So in this case, tax is also lower. Now, what about net income? Well, you can see that net income is actually lower for the firm with leverage. Now, what's your initial conclusion from this table? It seems that using leverage is a bad idea, right? Because you have to pay interest expense, and net income for shareholders actually becomes lower if you have leverage. But this thinking is actually incorrect, because in a case with leverage, we actually have two different investors. We have debt holders, right? And we also have shareholders. And in the case of without leverage, we only have shareholders, right? So basically, if you consider the total cash flow available to the firm's investors, you can see that in the case when the firm is having leverage, the total cash, the total money available to the firm's investors is given by 57.6 plus 612.6, right? So this is the money to, you know what, I should not include this minus sign here. So this is the money to debt holders. This is the money to shareholders. And you can see that in the case without leverage, because we don't have debt holders. So this is the money to shareholders. Now let's think about the money to, or the total money to investors, right? So in the case of the firm having leverage, then the total money is given by 57.6 plus 6126. And in the case when the firm has no leverage, it's just 655.5. So what is this number here? Let me see. I think it's 67. Okay, I have to copy the lecture note. 670.2. Right. Now, look at these numbers. You can see a very interesting result. That is, if the firm is using leverage, the money, the cash returned back to investors is actually larger, right? So what's the difference here? Let's see what is the difference. The difference is 67.2 minus 655.5, which gives you 14.7. 14.7. Now let's think, why do we have this additional 14.7, right? So let's look at the taxes here. Let's look at this guy and this guy. If you do the calculation, you will see that 225.4 minus 2107 exactly equals 14.7. So what does this tell you? Well, it basically says that the additional money to investors comes from the saving from tax, right? Because with leverage, the firm is paying lower taxes, right? So that's very easy to understand. And another way to look at this number is if you use the firm's interest expense, this guy, right? If you use the firm's interest expense times the corporate tax rate, which is 25.59%. Again, this will exactly be 14.7 million dollars. Oh, okay. Let me check if, yeah, it's 14.7. Right. So this is actually a very interesting result. Right. So you can see that these two numbers, they're the same. What does this tell you? Well, it basically says that this portion of the interest payment is shielded away from this corporate tax. Right? And that's why the firm with leverage will have this additional money. Right? Which is quite easy to understand because we know that in reality or in accounting, interest expense is a expense, it's a cost, right? So it will offset your profit, or more precisely, it will offset your EBIT. So this will reduce your taxable income, or you could say interest expense is tax deductible, right? So in this case, it will help you save tax. So basically, the additional money comes from the saving from tax, right? So it's just your tax saving. Okay, that's very easy to understand. So how do you exactly calculate interest tax shield? Well, from this example, we know that this 14.7 is the interest tax shield. That is the additional money you can get because the interest payment is shielded away from corporate tax. Now, how do you get this 14.7? Well, we know it equals interest payment, right? Interest payment 57.6 times corporate tax. So basically, this simple calculation basically tells you that interest tax shield equals interest expense times corporate tax, right? So that's why you get this formula here. Interest tax shield equals corporate tax rate times interest payment. Remember, this guy is interest payment. It's not the level of debt. It's not D, right? It is not the level of debt. It's interest payment, right? Okay, let's look at this example here. So here we have the income statement for this firm. And we assume the firm has a corporate tax rate of 35%. The question is, what is the amount of the interest tax shield for the firm from years 2012 to 2015? I mean, this is pretty easy, right? Because we know that interest tax shield equals interest expense times corporate tax. And if you go through this very simple income statement, you can see that interest expense is here and the corporate tax is here, right? So basically you can see that if you want to write down interest tax shield here, for the first year, 2012, it's 50 times 35%. So it's, I guess it's 16.5. So this is 25.5. I guess my mathematics is pretty bad. So it's 17.5 and 28 and 35 here and 35 here. Okay, how do you value the interest tax shield? So the important question is, we know that there is tax saving from interest tax shield, right? So the key here is we want to do the evaluation here. How do we calculate the firm's value if the firm enjoys benefit from interest tax shield, right? So first, let's think about this from the perspective of cash flows. So basically, you can see that cash flows to investors with leverage equals cash flows to investors without leverage plus interest tax shield. How do you see this? Well, let's just go back to our example here. Oops, I know it looks quite messy. So in this case, we know that interest tax shield is this guy, 14.7, right? And what is the cash flow for investors with leverage? It's just 612.6, right? And it equals 655.5, which is the cash flow for investors without leverage, this number, right? This number here, plus 14.7, right? So, oh, sorry, I was making a mistake. The total cash flow to investors with leverage is actually given by this number, right? So it's 670.2, right? So you can see that the cash flow to investors without leverage plus the interest tax shield equals the cash flows available to investors with leverage. Right? So that's why you get this this cash flow relationship here. And you could further look at this nice picture to understand this result. It's actually pretty simple. So here you can see that you have this EBIT here, which is your pre-tax cash flow, right? And it's essentially the cash flow generated by the firm's assets. And then if the firm has no leverage, then you can see that the EBIT will be divided into two parts. The money available to shareholders, which is the unlevered equity, and the money to government, right? Taxes. And then if you're a levered firm, the total cash flow, the pre-tax cash flow, will be decomposed into three parts, right? Earnings, that is levered equity, and interest payment, because now you have debt, and tax, right? Now, what's interesting about this picture is the size of tax, right? Previously, the tax size was actually pretty large if you're a unlevered firm. Right? It's this large triangle. But sorry, it's this large rectangle. But now, with leverage, the size of the tax actually becomes smaller, right? So you can see that there is saving. Now, what is this saving here? The saving obviously is the difference in the taxes under these two scenarios, right? So the saving here is given by this, right? So you can see why this is called this interest tax shield. Okay, we will continue to talk about this in the next class. In the next class, we will do this valuation. That is, we will try to calculate the firm's value with interest tax shield, and we will also calculate the value of the interest tax shield.